With all the economic headlines swirling around lately, you might have expected maybe a pretty straightforward, maybe even negative story from Topgolf Callaway brand's latest report. But their first quarter of 2025 actually served up a bit of a surprise.
Yeah. How so?
Well, even though their revenue wasn't quite as high as last year, they actually managed to beat expectations. So, okay, let's dig into what this all really means.
Exactly. So what we're looking at here is their Q1 2025 earnings release. Think of it like the company pulling back the curtain a bit, showing us how all their different parts are doing financially for those first 3 months anyway.
Right, and that covers, well, quite a lot. You've got the top golf venues people visit, the
Yeah.
actual golf clubs and balls they sell, and even their activewear side, like the Jack Wolfskin brand.
It's definitely a mixed bag of businesses.
For sure. So our goal today really is to cut through what can sometimes feel like, just a wall of numbers and financial jargon in these reports. We want to get to the real story, understand the key financial takeaways, the big strategic moves they're making, like selling off parts of the business and what this all points to for the rest of the year.
Yeah, without making your eyes glaze over with too much accounting speak.
Exactly.
So let's start with the big picture, right? How did this first quarter of 2025 stack up against Q1 last year? Well, their net revenue landed at just over $1 billion, $1,092.3 million to be precise. Now, that is a decrease, about 4.5% down from last year.
Okay, 4.5% down. But like you said at the start, that was actually better than they thought it would be.
It was. And the why behind that decrease is pretty interesting.
Their report points to a few things, right? Like top golf venues, the established ones, saw a bit of a dip in sales.
Yeah, same venue sales were down, plus they're deliberately sort of right-sizing their Jack Wolfskin operations over in Europe.
Oh, okay.
And then there's the usual suspect foreign currency rates. Those fluctuations didn't really help when they converted international sales back into U.S. dollars.
Right, the currency headwinds. But it's interesting, they also give that constant currency number. If you take out those fluctuations, the revenue decrease was a bit smaller, only 3.8%.
Which gives you a slightly cleaner view of the underlying sales trend. Yeah, that's a really important distinction to make.
So revenue down slightly, but better than feared. What about profit? How profitable were they?
Okay, so income from operations, using the standard accounting rules, GAAP, it was basically flat compared to last year, around $66.5 million.
Flat. Okay.
But, and this is where it gets interesting, if you look at their non-GAAP figures,
Yeah.
these basically strip out some one-off or non-cash items to give a clearer picture of ongoing performance.
Right, the adjusted numbers.
Exactly. That non-GAAP income from operations jumped pretty significantly, up 20.9% to $87.8 million.
Wow, quite a jump.
Yeah. And on that constant currency basis we mentioned, it's even higher, up 28.5%.
So what drove that big non-GAAP increase?
Mostly their golf equipment segment,
Yeah.
actually, and also the active lifestyle part.
Mm.
This really signals some, underlying strength in their core product lines. Seems like their cost management or maybe pricing power is really kicking in despite that slight revenue dip.
That feels like a more telling insight than just the headline revenue number.
I think so too.
Mm.
And you see a similar pattern with net income, the profit after everything.
Okay, how did that look?
Well, the standard GAAP net income actually dropped quite a bit, down to $2.1 million from $6.5 million last year.
Okay, a drop there.
But again, the non-GAAP net income, the one trying to show that core operational profitability, that increased substantially. Went up to $20.3 million from $14.4 million.
So the theme seems to be top-line revenue dipped a bit, maybe due to some specific factors, but the core operational profitability looks like it's improving. They're getting more efficient.
That's a good way to put it. It suggests they're managing the business effectively underneath that headline number.
You mentioned those non-GAAP adjustments, stripping out items. Can you give a quick sense of what those might be? Like, why look at both?
Sure. So non-cash items are things like depreciation. The way accounting recognizes assets losing value over time, even if no cash actually leaves the building right then.
Got it.
And non-recurring items could be, say, costs from restructuring the business, or maybe a one-time gain from selling something off. Analysts often focus on non-GAAP because they feel it gives a better sense of the ongoing core business health.
By taking out those maybe less predictable bits?
Exactly. But you always want to look at both GAAP and non-GAAP to get the full story. Oh, and another key measure, adjusted EBITDA.
Earnings before interest, taxes, depreciation, amortization.
Yeah,
Yeah.
right. That also saw a nice increase of 4.0% to $167.3 million. Again, pointing towards better operational performance.
Okay, so a bit of a mixed bag on the surface, but digging deeper shows some positive operational trends. Let's maybe zoom in on the different parts of the business now. How did Topgolf itself do?
Right, the Topgolf segment, its revenue was down 6.9%, came in at $393.7 million. And again, factoring out currency, it was down 6.9%.
Okay, and why was that?
The main driver was that decline in sales at the established venues, the ones open more than a year. We call that same venue sales. That drop basically offset the money coming in from brand new venues they opened.
And how much were those same venue sales down?
They were down 12%, which, sounds like quite a bit.
Yeah, 12% is significant.
It is, but here's the kicker. This was actually in line with what the company was expecting. It wasn't a negative surprise to them.
Ah, interesting. So they'd already factored in that kind of slowdown. What about profitability for the Topgolf venues? Did that take a hit?
It did. The operating income for Topgolf actually swung from a small profit last year, about $2.9 million, to a loss this quarter of $11.9 million.
Ah, okay.
Yeah, and similarly, their adjusted EBITDA for Topgolf decreased too, down to $43.9 million from nearly $60 million last year. So that drop in same-venue sales definitely flowed through to the bottom line for that segment.
Even though they mentioned working on costs.
Right, they are actively working on cost reduction, which likely cushioned the blow somewhat, but yeah, the sales drop still had a noticeable impact there.
All right, so some challenges for the Topgolf venues. Let's pivot to the golf equipment side. That seemed like a different story based on the overall profit numbers.
It really was. Now, golf equipment revenue also saw a small dip, down 1.4% to $443.7 million. Again, almost flat, down just 0.3% if you take out currency effects.
Okay, so revenue fairly stable there.
Right. But you have to consider the context. They specifically mentioned, one, those unfavorable currency rates, and two, a really competitive market right now. Apparently, all four of the big golf equipment makers launched new lines of drivers and woods, the big clubs, during this same period.
Oh, wow. Okay, so everyone launching new stuff at once.
Exactly. So for their revenue to hold pretty much steady in that kind of environment, that's actually quite resilient, I'd say.
Good point. So revenue held up well considering. What about the profitability of selling clubs and balls?
This is where the golf equipment story gets really impressive. Their operating income for this segment surged. It increased dramatically by 23.8%, hitting $101.6 million.
Wow, okay. Up nearly 24% on a essentially flat revenue. How'd they manage that?
A few key things they highlighted. One, improved gross margins, meaning they made more profit on each item sold. Two, those cost-saving efforts we talked about, clearly paying off big time in this segment.
Uh-huh.
And three, they had a bit of a one-time boost from a lease agreement ending over in Japan. But even without that, the underlying improvement was strong. This segment was a real engine for their overall profit growth this quarter.
That's a very strong performance, especially with that competitive pressure. Okay, let's cover the third piece, active lifestyle. That includes Jack Wolfskin, right?
Correct. So revenue in active lifestyle was down 6.1% to $254.9 million, or 4.7% down, excluding currency effects.
And was that expected?
Yes, this seems largely driven by that strategic decision we mentioned earlier. They're
Yeah.
intentionally shrinking the Jack Wolfskin business in Europe.
Okay, so deliberate pullback there.
Right. Though they did mention that this was partly offset by some growth they're seeing over in China for that brand. So, yeah, the overall revenue dip seems like a direct result of that strategic right-sizing in Europe.
Makes sense. And how did that strategic move impact the profitability of the active lifestyle segment? Did profits go down with revenue?
Interestingly, no. Despite the lower revenue, the operating income for active lifestyle actually jumped significantly, up 23.9% to $30.6 million.
Another big jump,
The-
similar to golf equipment.
Yeah, it's a similar theme. They said this was primarily due to the cost-cutting they've done, specifically at Jack Wolfskin, as part of that shrinking process. Plus, they also saw better gross profit margins here, too.
So it looks like those strategic moves, even if they reduce revenue in the short term, are already boosting the profitability of that segment.
It certainly seems that way from these Q1 numbers, making the remaining business leaner and more profitable.
Okay, so that covers the performance of the different divisions. Let's talk about the bigger picture stuff, the major strategic decisions and what they're telling us about the rest of 2025. The really big news seems to be about selling Jack Wolfskin entirely.
Yes, that's a major development. They confirmed they have an agreement in place to sell the whole Jack Wolfskin business. and they expect that deal to close probably late in this current quarter, Q2, or maybe early in Q3 2025.
That is significant. What's the thinking there?
Well, the company says this will let them really sharpen their focus, put their resources and attention squarely on their core businesses, golf equipment and Topgolf. Plus, it'll help strengthen their balance sheet, their financial position, which is probably helpful as they think about that other big strategic move down the road.
The planned separation of Topgolf.
Exactly. Preparing for Topgolf to potentially become its own separate company later on.
And they gave some numbers on Jack Wolfskin's expected size for the year, right? Just to give us some context.
They did. Their previous forecast for Jack Wolfskin for the full year was around 325 million euros in revenue and about 12 million euros in adjusted EBITDA.
Okay.
And it's worth remembering that business has significant seasonality. It usually loses money in the first half of the year and makes its profit in the second half.
Which makes the timing of the sale, potentially before that stronger second half, quite interesting strategically.
It does. Now, beyond the Jack Wolfskin sale, they did mention that planned separation of Topgolf again. No firm timeline given yet, it seems.
Right, more of a future strategic direction.
Yeah, but it's clearly a major part of their long-term thinking about the company's structure. Suggests a future where Topgolf might operate more independently.
Which could let both Topgolf and the remaining Callaway Travis Matthew or Geo businesses focus on their own specific growth paths, maybe attract different kinds of investors too.
That seems like the potential logic, yes.
Okay, so with these big changes happening or planned, what does their overall forecast for the full year 2025 look like now? Did they change it?
Actually, no. They reaffirmed their main financial guidance for the full year. They still expect consolidated revenue to be somewhere between $4 billion and roughly $4.19 billion.
Okay.
And their adjusted EBITDA's forecast also remains unchanged, projected between $415 million and $505 million.
So keeping the overall target steady.
For now, yes. Though they did add a little note saying these numbers might need tweaking once the Jack Wolfskin sale actually goes through and is finalized.
That makes sense. You can't just lop off a business unit and have the total numbers stay exactly the same. What about the specific forecast for Topgolf? Sounds like there were some changes there.
Yes, there were adjustments specifically for the Topgolf segment guidance. They lowered their revenue expectations for Topgolf for the year. They now see it coming in between $1.68 billion and $1.79 billion. That's down from their previous range, which was closer to $1.73 billion to $1.84 billion.
Okay, why the lowered revenue outlook for Topgolf?
They pointed to a softer consumer environment, basically. People may be being a bit more cautious with spending, and that's hitting those same venue sales harder than they initially thought.
Ah, right. The same venue sales we talked about being down 12% in Q1.
Exactly. They now expect those same venue sales for the full year to be down somewhere between 6% and 12%. Their previous forecast was only for a mid-single-digit decline. So definitely seeing more pressure there.
So a more cautious view on Topgolf's top line, its revenue. But what about its profitability? Do they lower the profit forecast too?
Here's the interesting part again, no. Even with that lower revenue forecast for Topgolf, they're keeping their adjusted EBITDA guidance for the segment exactly the same, still projecting $240 million to $300 million.
So lower sales but same profit target. How?
They believe they can offset the lower revenue through essentially cost savings and efficiency improvements within the Topgolf operations. Getting leaner, basically.
That's quite a balancing act. Maintain profit levels even as sales dip more than expected. That's a key thing to watch.
Absolutely. It shows confidence in their ability to manage the operational side.
Okay, so that's the full year. What about the immediate future? What are they expecting for Q2, the current quarter?
For Q2, they're anticipating a few things. One, that golf equipment market will stay very competitive with more new products hitting shelves. Two, the effects of shrinking Jack Wolfskin will continue to be felt. Three, there's still some lingering impact from selling off their WGT online golf game business back in December 2024. And four, they expect that decline in Topgolf's same venue sales to continue in Q2, forecasting it down between 7% and 12%.
So it sounds like Q2 might still have some headwinds. Are there specific financial impacts they mentioned for the quarter?
Yes, they did flag that their overall adjusted EBITDA for Q2 is likely to take a hit of around $22 million.
Okay, from what?
It's a combination of things. Losses on some financial hedging contracts, the ongoing impact of tariffs on goods they import, and the financial effect of no longer having that WGT gaming business contributing.
Right, so several factors dragging on Q2 profits specifically.
Seems that way. They're definitely navigating some near-term challenges.
And just stepping back, what are the broader sort of macro factors influencing their outlook generally?
Well, those macroeconomic conditions are definitely key. Things like the tariffs we just mentioned, and that generally softer consumer spending environment they cited for the Topgolf adjustment.
Right.
They also mentioned foreign currency exchange rates, which were a negative in Q1, are actually showing signs of improving now. So that could become less of a headwind, maybe even a slight tailwind later.
Okay, potential positive there.
And of course, their own internal efforts, especially around cost reduction and efficiency, remain a really significant factor in how their results will shape up.
Okay, wow. We've definitely covered a lot of ground in this deep dive. If someone's listening and trying to just boil it down, what are the absolute key takeaways from this Topgolf Callaway brand's earnings report?
Okay, boiling it down, I'd say, firstly, yeah, overall sales dip slightly, but don't let that fool you. Their core profitability, looking at those non-GAAP numbers, and adjusted EBITDA actually improved. That signals their efficiency drives are working.
Good first point. Efficiency gains are real.
Secondly, the golf equipment business is a standout performer right now. It's holding its ground, even growing profits significantly in what sounds like a really tough competitive market.
Strong core in golf equipment. Got it. What else?
Thirdly, Topgolf. It is facing some real challenges with getting people into the established venues. Those same venue sales are down. But, crucially, they seem to be managing costs aggressively to protect its profitability, keeping that EBITDA target stable.
Okay, Topgolf. Sales pressure, but managing costs.
Fourth, the big strategic move selling Jack Wolfskin, planning to eventually separate Topgolf. These clearly signal the company's future direction. It's all about focusing on the core strengths in golf and that unique Topgolf entertainment experience.
Sharpening the focus. Makes sense.
And finally, despite tweaking the outlook for Topgolf's revenue, the fact that they reaffirmed the overall financial guidance for the whole company for the year, well, that suggests a decent level of confidence.
Mm-hmm.
Confidence in their ability to navigate these choppy economic waters and still hit their main targets.
Right. So, putting it all together, Topgolf Callaway Brands is definitely navigating a complex environment, making big strategic bets with the Jack Wolfskin sale and the future Topgolf split. Golf equipment is humming along nicely, offsetting some of the pressure on the Topgolf venue side, and overall, they're sticking to their financial plan for the year.
That sums it up pretty well and leaves you with a really interesting thought to ponder. How will these big strategic shifts, this intense focus on core golf and entertainment, actually shape the future? Not just for the company, but for the whole modern golf experience and maybe even the wider active lifestyle market. What kinds of new opportunities or maybe challenges could spring from these changes down the line?
That's a great question to leave folks with.
Yeah, I mean, this earnings release gives us a really valuable snapshot of where things stand right now. But the longer-term ripple effects of selling a brand like Jack Wolfskin and setting Topgolf on its own path, that'll be fascinating to watch unfold.
Definitely something to keep an eye on. And just a reminder, of course, that our deep dive today is based on this specific earnings report. For the truly complete picture, you'd want to keep exploring the company and the industry more broadly.